Hello, 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 hello. Welcome to the Business Plugs Mixer Special Edition. See, I'm doing something for you. Today is a special edition of the Business Plug Mixer because today we're talking about something that every business owner should be thinking about in this period. Today we're talking about taxes. We're talking about small business taxes and the 2022 tax laws. So you're going to want to lean in if you are an entrepreneur who had a business in 2021. You're going to want to lean in because my guest is none other than Tracy Tate. Hey, Tracy.
Hey, thank you for having me. I am so honored to be a part of your show.
Well, honey, we are glad you're here because this is tax season. And so we are looking for some answers, some shortcuts to what we should be doing, getting ready for this tax season. Most of us are not ready to file yet, but still we want to know what we need to do, what we need to be aware of, and how we can make this our best tax season ever. And of course, I thought of you. Of course, I thought of bringing you on here and letting you tell the world about how to get ready for this tax season. So with that, I'm going to give you the floor and let you introduce yourself and start your presentation.
All righty. Hello. Thank you for having me. I'm going to start my presentation because my presentation introduced who I am. So let me do that. Here we go. So let me go on and get started. I'm putting it in slide view. So welcome. Thanks for joining us today. I will be going over not only tax basics, but also accounting. So welcome to Accounting and Tax Basics for small businesses and entrepreneurs. Okay, so a little bit about me. I am Tracy L. Tate. I have an MBA, but I'm also the CEO of TLJ Professional Services, where we are about all things financial. We are BBB accredited with A+. I've been in the accounting industry for over 35 years. I am also IRS and FTB, Franchise Tax Board registered in the state of California, the state, but I do cover the entire United States. I am a licensed life and health agent. My license number is on the screen. And then our services. We do tax prep for individuals and corporate. I've been doing taxes for over 35 years, as well as been in the industry. We do bookkeeping and accounting services, as well as business coaching, business filings, QuickBooks setups, reconciliations. And again, I'm a life and health insurance agent, and we do annuities for retirement. Now, let's jump right in. This is what we're going to cover. Accrual versus cash basis. That matters in your tax return. Okay. Bookkeeping versus accounting, business structures, tax forms, best practices, and do's and don'ts. So right off the bat, accrual versus cash basis. So accrual is when you record a transaction when it occurs, okay? Versus cash basis is when you actually receive the payment, okay? Accrual, you also account for your revenues when your services are rendered or your products are ordered. So you account for your sales in advance of receiving the money. Whereas with cash basis, it doesn't count until you do receive the money. And that's why it matters which basis you are in your tax return, okay? And it does impact your tax liability, okay? You account for revenues when they're received, as well as your expenses are accounted for when they're paid. Not when you place an order, like in the accrual basis, but when you actually pay for the expenses. And then last but not least, accounts for expenses when the activities incurred, that's an accrual. And then you record activities when the payment exchange hands. So this is important because most people, especially as small business owners, as well as entrepreneurs, you are cash basis, okay? You have to elect and say that you want to be accrual. So if you're counting your activities based on your bank statement or based on your banking activity, you're operating on a cash basis. Most accrual basis is depending on the industry, but you choose as the business owner which basis you want to be. So you could be accrual or cash regardless of your industry, but accrual basis companies are normally companies like C Corps or big corporations. They will accrue, Or like if you do, like the restaurant industry would be normal for accrual because they place orders before they actually pay for the product. So if you do a net 30 term, and this is relevant to your customer base as well, if you offer net 30 or if you pay for your expenses in a net 30 term, you are operating in an accrual basis. Otherwise, you're cash, where I buy something, that's when it accounts for it, right? That's when you account for the expense or the income. You have a new client, you account for the income that you receive. So nowadays, there's a lot of platforms that allow you to split your payments, right? From a cash basis, you only recognize the amount of money that you've collected. Okay, that's the only thing that goes on your financial statements. However, as an accrual, you would account for the entire sale. Okay, so that's a perfect example of accrual versus cash basis. But it's important because your financial statements is how your taxes are prepared, and how you present your financial statements impacts your tax liability. So if you record on an accrual basis versus cash basis, you're accounting for more activity in most cases than the cash that you actually collected. So be mindful of your basis, because a perfect example too is you can give your tax preparer a cash basis statement, but if you operate on accrual, you're really understating your revenues and or expenses. Okay, that matters. Okay, so the type of basis you need to be clear to provide your tax preparer with the right reports so that they can prepare your taxes accordingly. Now, bookkeeping versus accounting. People get confused on this, so I always like to talk about this when it comes to taxes as well, because bookkeeping is the day-to-day recording of your activities. So this is where your accrual versus cash basis come in. And this is what I was talking about as far as your reports. Your reports is going to be based on your bookkeeping. Your financial statements are prepared from your bookkeeping. So it's the recording of your activities. So sales, purchases, payments, AR, AP. So that's accounts receivable or accounts payable. Accounts receivable are where customers owe you. Accounts payable is when you owe a vendor, okay? And then your expenses. There is a such thing as a full charge bookkeeper that handles everything, including your bookkeeping and accounting, versus just a bookkeeper. So just know, as a business owner, as a small business owner, as an entrepreneur, if you're doing your own books, you're serving both functions. Otherwise, you can hire a bookkeeper and don't have them do the accounting, or vice versa. Okay, you can record your own transaction and have an accountant review your entries for the best tax return that you can have. Okay, so remember, your financial statements directly impact your tax liability. Okay, so it impacts your tax return. So accounting or an accountant actually looks at your financial statements. Okay, it looks at financial metrics. It reconciles your bank accounts, your general ledger. So again, this could be something that your bookkeeper is doing as a full charge bookkeeper, or you hire an accountant to make sure everything that the bookkeeper does is in according to your business method basis. So remember the accrual versus cash basis, because that matters. That's where an accountant comes in as well. They also do reporting. So publicly traded companies, they have their accountants or CPAs prepare their financial statements for the SEC reporting. You, as a small business owner, as an entrepreneur, your financial statements is how your tax returns are prepared. Okay, so as a accountant as well, because I'm an accountant, also review your numbers and your company position. So we, as a business, TLJ Professional Services, we do bookkeeping and accounting, and they are separate, as well as taxes. Bookkeeping, accounting, and taxes are our specialty. So moving right along. So there's 4 different structures, and there's one tax implication. So business structures are sole prop, LLC or LLP, C Corp, and nonprofit. A LLC or a C Corp can elect to be an S Corp. And I'm going to go over each one of these. So number 1, you can identify what type of business you are if you don't know, right? And then the pros and cons of each one and how they impact your taxes. So the regular tax forms are Schedule C. That's for if you're a sole prop or a single member LLC. What a single member LLC means is that in a business, you have a president, a treasurer, and a secretary. Single member means that you hold all 3 positions, okay? Multi-member would be that you have partners in your business, okay? So Schedule C is you do not separate you from your business. It's combined into one. This goes on your personal tax return, 1040, with the Schedule C. If you're a multi-member, you do a Form 1065 or partnership, where you get a K1, which identifies your percentage of ownership of your net profit or loss. Okay. So if you are, and it could be partners, 2 or more, right? So if you have a partner in your business and you guys are 50-50, then you split down the middle the net profit or the net loss in your business. If you have 3, it could be based on your percentage of ownership. So if you guys each have an equal amount of ownership, it'll be 33, and one person, which is normally the person that created the business and is responsible for everything in the business, will get that extra 1% to make it 34%. But it's what you agree upon. So a partnership, multi-member LLC, is a contract where you have an agreement with your other owners or members for their percentage of ownership. They can own 10%, 20%, whatever. It just needs to equal 100%. And based on your percentage of ownership, you get a K1 on that. And I will go into more detail on that form. And then Form 1120 is for C corporations. Form 1120S is for S corporations. And then 990s are for nonprofits. Now, there are several Form 990s as well. There's the EZ, there's the full form, and then there's also the N or E-file, okay? Now, Schedule C. As a single member LLC, or sole prop, you capture your revenues, your cost of goods sold, any expenses that you have. So anything that you pay out of pocket to make your business function, whether it's business meals, whether it's supplies, all of those things are part of your deductions that you can have on a Schedule C. That includes any vehicle, so your mileage. A lot of people do mileage because you actually get more, or is more balanced than if you do actual costs, because you can do, for a vehicle, you could do actual cost, which would be your actual gas, your actual repairs, okay? You automatically get to write off your parking and bridge tolls, whether you choose to do the mileage or the actual expenses. Those are deductible regardless. But if you choose actual, it would be how much did I actually spend in gas or to get my vehicle repaired. For the most part, you should not be repairing your vehicle every year. So that's why some people, and most people in small business, when they deduct their vehicle expenses, they do it based on miles. And that accounts for the wear and tear on your vehicle. Okay. So with that, you either do the miles plus parking and bridge tolls, or you do your actual out-of-pocket expenses plus parking and bridge tolls. You do not get to flip-flop from year to year. That's a no-no with the IRS. You choose the stance that you want to have, and that's what you use. So if you're in an industry that does a lot of miles, you may want to choose mileage, because maybe this year you might not have repairs, but next year you might. So doing actual expenses, you may lose by not doing the mileage versus actual expenses. Okay. But it's what's best for you and your business. Nothing in taxes is a one size fit all. Nothing in taxes is uniform. Everything is unique to you in your business and how you want your business to operate and your big goals. Okay. There's also additional expenses depending on your industry. It could be something specific to your industry. Continuing education, people forget about that. If you attended this, if it costs you money to attend this, right? I know Miss Linda give away a lot of stuff for free, but if any time that you attend a webinar, a conference, buy books to perfect your craft, that's considered continuing education, and you can write that off. Okay. The thing about a Schedule C is you have to account for self-employment tax. What that is, it accounts for your old age survivor disability Medicare. Okay. So that's you contributing toward your retirement. And then as not self-employed, right? Or if you're one of the other entities, which I'll go into, you don't have to worry about the self-employment tax because more than likely you are an employee of the business. Okay. So with sole prop, single member LLC, or even if you're a partnership, multi-member partnership, you may have self-employment taxes depending on how you guys file your tax structure. Okay. So Form 1065 is for partnerships. So a lot of partnerships or LLPs are attorneys. So you'll see law office of so-and-so and so LLP, right? So otherwise you're LLC. So there's specialized industries that have limited liability partnerships versus limited liability company, which is an LLC. They are pass-through entities, and what that means is, like I was saying before, your K-1 will be based on your percentage of ownership, okay? Your profit and loss or your K-1 is included on your 1040, okay? So on your personal tax return, depending on if it is a profit or loss, you would include that on your personal tax return unless you elect to be an S Corp. I will go over S Corp in detail. I am pro S Corp. I am biased to S Corp as a business, as a small business. You cannot be an S Corp as a sole prop, okay? You can elect to be an S Corp as an LLC, whether you're a single member LLC, multi-member LLC, or C Corp, okay? But as a partnership, your tax document is strictly a K-1 for personal individual tax return purposes, okay? But the business return is filed on Form 1065, and you will get a K-1 out of that. Now, something that I have experienced with a prior client, and actually they're a current client, but they were prior for someone else. They never got a copy of their 1065. They only got their K-1s. It's like, no, you're entitled to see the tax return for the business. You're entitled to see your financial statements for the business. Otherwise, how do you know how the business is going, right? Or what your share of the profits are to be prepared for that. Because one thing about a K-1, there's no prepaid taxes in a K-1. So what I mean by prepaid taxes, when you work for an employer, you have a W-2. Every taxes that's taken out of your paycheck when you're a W-2 employee, that's prepaying towards your tax liability at the end of the year. When you're sole prop, you do not do that unless you pay quarterly taxes, meaning that whatever your tax liability is at the end of the year on your net profit, you'll owe that amount. You will not get a refund unless you actually pay taxes. So remember, taxes are prepaid in order to get a refund, unless you get some of the refundable credits from a personal standpoint. Okay. From a business standpoint, you cannot expect a refund unless you paid pre-taxes into the IRS or to the state, which you would get a refund if you overpaid your prepaid taxes. So you can recall on the Schedule C, I mentioned about the self-employment taxes, the Medicare and Social Security. When you're an employee that work for someone in the other entities, you could be an employee of your own business. But when you're an employee, your employer pays half of your Medicare and half of your Social Security. That's your self-employment tax when you're Schedule C, sole prop, or LLC, okay? Single member LLC. So just be mindful of that you are entitled to see the tax forms for the business that you're a part of, if you're in a partnership or LLC, multi-member, okay? And your percentage of ownership will be indicated on your K-1 so that you know exactly what to include on your tax return, okay? Now, Form 1120 is for corporations. It is not considered a pass-through entity. So pass-through entity simply means that the corporation or entity, because it doesn't have to be a corporation, LLC is a company, it means that that entity does not pay taxes at a business level. C Corp, you do. So on Form 1120, you have a tax liability as a C Corp, okay? The other entities are considered pass-through, meaning you as an individual, you get your K-1 and it's included on your individual return based on your percentage of ownership, okay? Any dividends or money that you take out of a C corporation must be included on your tax return. Otherwise, it's just the company or the entity, in this case, corporation, that pays taxes. You as the individual owner in the company would not, unless you took dividends or you took money out the business. So Schedule C, my favorite. So it's an 1120S. It just means that you're electing to be taxed as a corporation, meaning that you get to take all of the deductibility that a corporation does, although you may be an LLC or the C Corp, right? It gets those tax advantages of the S Corp. And part of that tax advantage is what you get to write off, okay? So again, it's based on your percentage of ownership that is reported on your K-1. Again, it cannot be associated to a sole prop or single member LLC unless you elect to be an LLC, taxed as an S Corp, okay? No corporate tax returns. So that's what I mean by the pass-through. So it is considered a pass-through entity. So the business does not pay federal taxes. It will pay a franchise tax to your state. So California is 800. Florida has a different amount. Texas has a different amount. So you would pay your franchise fee. It's not an income tax like with a C Corp. Those are income taxes, okay, for the business. This is considered a franchise tax. And yes, you get to deduct this expense on your P&L or your profit and loss on your financial statement, okay? I did not create a slide for nonprofit, but just so that you know, nonprofits, you do not own a nonprofit. You are considered a founder, president, or board member, okay? A president is a board member. People get confused with they own the nonprofit that they establish. You do not own it, okay? Your board owns it as a community charitable organization, depending on the type of nonprofit you are. So if you're a foundation, it's expected that all the monies that you collect in from a deductible standpoint, you issue back out to other charities, okay? It is not for the foundation to keep except to perform its operations. It has to give out or fund other nonprofits with any money it collects. So nonprofits is not part of your personal tax return whatsoever, but it is a business. And therefore, it does have to file taxes as well. And you would file Form 990. If you receive donations of less than $50,000 in a year, you could do the postcard. It's called an e-postcard. Otherwise, you would do a 990 EZ. If you have a simple nonprofit, larger nonprofits like the Boys and Girls Club, they are not a simple nonprofit. Therefore, they have a larger, they use the regular Form 990, which is a full nonprofit form or tax form. So best practices. This is bookkeeping best practices. And this is so that you're able to make adjustments to your financial statements before tax season. Okay, so best practice, know your monthly, quarterly, and annual numbers. Okay, what is your financial position? Your return on investment? Are you at a profit? Are you at a loss? Are you paying too much for your cost of goods? Cost of goods sold is the items that go into preparing what you sell. So service-based, you would not have cost of goods sold. But if you're a creative person and you have to buy materials or supplies to actually produce what you sell, those are cost of goods sold. But your cost of goods sold should directly dictate and impact what you sell your item for. If it costs you, which is cost of goods sold, if it costs you $10 to make, you can't sell it for $10. You can't sell it even for $12 because you would have no profit because you still have other expenses, overhead expenses. So you look at your cost of goods sold from a standpoint of how much do I charge for this product if it costs me X amount of dollars to make? And that's where you want to look at your financial position, your gross profit from your cost of goods sold to make sure that you're charging the right amount for your goods. Okay. So again, did you earn a profit or a loss this month? And how can you adjust? What caused a loss if you made a loss? What caused the profit if you made a profit? Like what's working and what's not? That's why you want to look at and know your numbers monthly, quarterly, and annually so that you can make adjustments along the way. Record keeping is a must. From a financial standpoint, you need to keep your documents for at least 7 years. I do still recommend 10. It used to be 10. Now they're saying 7 because a lot of stuff can now be digitally stored. I recommend 10. Keep it organized. And that way, when that 10th year is up, you could delete the whole file. No way are you in risk of audit, questions about your returns from 10 years ago, etc. Even in lawsuit. 7 years, that's still that window that from a lawsuit perspective, you may need your documents. And that's why I recommend 10 years. But by law, you only need to keep them for 7 from an IRS standpoint. But from a lawsuit standpoint, you may need to keep 10. Okay. Investing yourself in your business. It is a must. If you're running a business as a side hustle, you may not because it's just supplemental income. But if you are running and operating a business, whether you are a sole prop, a C Corp, S Corp, or LLC, you have to invest in your business, okay? Keep up with relevant information on your industry. So that's that continuing education that I talked about, okay? Courses, certificates, anything that allows you to stay abreast of what's going on in your industry or how to keep your business running, how to expand it. That is a deduction for your business. That's a cost to keep your business in operation. Outsource what you're not an expert in. We can't be good at everything. I always say, be good at what you're good at. Let us be good at what we're good at, right? Because like you're an expertise in your field, we are in our field, and your numbers, let me put it that way. Your numbers can make or break your business, okay? It's kind of like, even like with insurance. Would you try to create your own insurance or try to mimic what insurance would do? Or just invest in buying insurance for that added protection, right? That's what accountants, that's what bookkeepers do. That's that extra insurance to make sure that your numbers are right, because they directly impact your tax return, and they directly impact your loans, like your ability to obtain a loan, or to obtain credit, or to obtain to sell actually your business, obtain a sale of your business. So what's your exit strategy of your business? Do you have one? Mine is to leave it as a legacy for my business. It's generational wealth for my family. Okay. But what's yours, right? It matters. So that's all part of your best practices. Do's and don'ts. Open a business account. Always separate your business from your personal. Although with sole prop, you are considered as one. What's considered taxable income to you, what's taxed in your self-employment tax, all of that is based on what you record in your Schedule C or as your profit and loss for your business. Having a bank account will allow you to single or monitor your business activity more easily. If you commingle your activity with your personal funds, how will you know a year from now, or now is tax season, that expense from January last year that was in your personal account, is that business or personal? Do you know? Do you recall? Some items you might could tell, but in some cases you won't. And guess what? That's leaving money on the table, because you won't include that as a deduction. Therefore, you're paying tax on something that could have been deducted, right? Think about it. All receipts or payments are recorded in your business bank account. That's what I was just talking about. Hire an assistant in order to scale your business, depending on your industry, of course. So even service-based, I cannot scale my business without help, period, because I can't do everything. I outsource what I don't know how to do, what I don't want to learn a whole nother area like marketing. I refuse to learn a whole lot about marketing. That's not my forte. Numbers are, right? So I outsource it. So that's my assistant. I outsourced things that I do not have time to do myself, or the learning curve to get it done would take me farther more time than just having somebody else that's an expert in it do it, right? Reconcile your accounts. The IRS make mistakes, and so does banks, okay? Always look in your account. You will also not be able to recognize that somebody have dipped into your account. You know, there's a lot of fraud, there's a lot of hacking and all of that stuff going on. If you don't check your accounts regularly, you won't know, or you won't identify an item until it's too late, or you won't identify it at all because you don't check, right? File your taxes monthly, quarterly, or annually on time, okay? The monthly and quarterly is sales tax, payroll tax, right? Prepaid taxes, if you choose to do that, depending on your industry, it may be required. And also depending on the amount of money that you make in your business, it may be required. Some don'ts. That's what I was talking about. Do not commingle your business and personal funds. They should be maintained separately, okay? Don't leave money on the table, okay? Know when to outsource and get help, because time is money. The more time you spend trying to figure something out that you could have hired somebody to do, you far exceed, because your time is value, right? Time is money. You could have just paid somebody to do it instead of taking your time away from your business, away from your craft, away from growing your business, right? So outsource where necessary. Never ignore IRS or state letters, okay? Like I said, they make mistakes too. So definitely look at your notices, and as long as you communicate, they won't do things like liens and taking money out your account and stuff like that. A lot of people are afraid of the IRS. Don't be afraid of the IRS. Communicate. They don't know if you don't tell them. You don't ask, it's an automatic no, right? So don't ignore your notices. Contact them immediately with whatever it is you need to do to make sure everything is right and smooth with the IRS and the state. Make decisions. Do not make decisions through emotion. Always plan, plan, plan. Pivot where you need to, okay? The pandemic threw everybody for a loop. And there was a lot of businesses that closed based on emotion. Oh, my business ain't going to work in this. I can't deliver. It's called pivoting. So never make a decision based on your emotions. Plan it. Now, there is a difference between making the decision on emotion and stepping out on faith, because I plan to step out on faith. Okay. That's not an emotion like, oh, they doing this, so I'm doing it. So a lot of people jumped on the LLC bandwagon, don't know what it means, what it do, nothing, right? That was an emotion. They're doing it, I should do it. No, there is no one size fits all. You do what's best for your business and in your business. And that's how you make the best decision for your business, okay? Now, this is ways you could contact us. TLJProfessionalServices.com. You can follow us on all platforms with TLJ Professional Services. You can get a free 30-minute consultation at bit.ly.com/TLJ consult. So it's bit.ly/TLJ consult. It's the bit.ly.com access. Or you can contact us through our 800 number. Tax season actually opened. E-filing actually opened on January 24th. Okay. The deadline this year, where it's normally April 15th, they're actually extending it to that Monday, April 18th. So you have until April 18th to either file your return or file an extension. We do accept clients all year long, and take advantage of your free consultation. Either we would be a good fit for you or we would not. And I appreciate your time today. I hope you learned a lot in this lesson. I'm excited about this tax season. I'm excited about what's to come. And I hope that you enjoyed it as well.
So thank you. I don't know about anybody else, but I'm sitting there taking notes, and I'm still going to have to go back and do a replay of this, right?
Right.
Because that's a lot of information, but it's good information. I love that. I tell my students all the time about commingling their revenue and their personal. I tell them all the time, because also if you've put that LLC to kind of be a hedge against your assets, around your assets. And then if somebody should sue you, God forbid, but if somebody should sue you and they can prove that you've been using both of them as your personal, then you lose that
protection, right?
You lose the protection. And so I tell my students this all the time is no. Separate account for the business, separate account for the personal, and don't let the two meet. Even if you put them in different banks, just do it different. Just keep them separate, because that's going to be to your benefit in the long run, in taxing and in legalities if somebody gets crazy and want to come after you. So but so much information and good information about how to file and how to structure yourself, how to protect yourself. I get questions all the time about the C Corp, right?
Yes.
Should I be a C Corp? And the benefits kick in at what revenue point?
Multi-million, not just 1 million, but multi-million. So the way that you really look at C Corp is that you want investors in your business, but you no longer own it. You want to keep the higher shares, right? Because if you give out more shares than you own, then you no longer own the business. See, that's the difference with a C Corp. It's the ownership structure, because your shareholders become your owners. And depending on how much you give out, if you don't hold the majority, you no longer own your business.
And you could very well lose it.
You could very well lose it. You could lose they could vote you out as the president and everything. They could kick you off your own board.
Exactly.
That's even so in nonprofit. People don't realize you can get kicked off as president even from your board in a nonprofit because you don't own it. See, a C Corp and nonprofit are almost one and the same. A nonprofit is like a C Corp, except it just doesn't use the word C.
Right.
It's charitable, right?
Right.
But you can lose a lot in a C Corp.
And that's what I tell, and that's what I try to express to people that want to do nonprofit. Nonprofit is great. First, let me say that.
Yes.
Nonprofit structures are great, and they do great work in our community, and they keep our community afloat. However, if your dream is to open a business as a nonprofit, my suggestion is that they open a for-profit that they can get paid with, and then they open a nonprofit to be that charitable.
Right.
Because they're not the same. One belongs to the community, the other can belong to you.
Exactly. The thing about it is, because I have both, right?
Mm-hmm.
My for-profit business funds my nonprofit.
Absolutely.
Quite a bit. But it's a write-off for my for-profit.
Exactly.
Right? And it keeps my dream, my give back to my community alive, because it's a business, right? A nonprofit is a business. People get confused about that too. It is a business. You don't own it, but it takes money to stay afloat.
It does.
Right? Just like a normal business would.
It does.
And as a nonprofit, you get money from the community in order to support the community. But yeah, a lot of people get that confused that, oh, well, I'm going to open a nonprofit. Okay, but you don't own a nonprofit.
Exactly.
You got to know what you open it.
Exactly.
So,
and the thing, what they don't realize is, okay, let's say you get to the end of the road and you're like, okay, I'm not going to do this nonprofit thing anymore. You have to give your assets to another nonprofit.
Exactly.
You don't get to close them.
You don't get to sell them nothing.
I can't keep the treasure.
No.
You can go to jail. You can go to jail keeping the treasure.
Right.
And you have to get the IRS's approval to how you dispense of that.
Exactly.
Like, you just can't go out of business and say, oh, well, I'm not going to do this anymore. I'm just going to keep all the revenue and the assets.
Mm-hmm. You can't
do
that.
You would be in jail, and we'll see you on the news.
Right. Yes, we will.
Because you don't want
lines, okay?
No, ma'am. Don't do it. Don't do it. Another question I get, Tracy, is about S-corps. Okay. Mm-hmm. S-corps are not for everybody.
They are not for everybody. I am very pro S-corp, but I look at S-corp from this standpoint. If you're running a hobby, S-corp is not it. If at all, you know what I'm saying? S-corp is valuable when you have multiple offerings, multiple streams of income coming in, because an S-corp almost is treated like a umbrella company or a holding company, right? And you could have other companies underneath, different avenues. So I use the example of hairstylists a lot, or the hair industry, because that's popping right now. Right. Now, if I'm a hairstylist, just a hairstylist, no, don't be an S-corp. However, if I'm going to own the building, rent out booth rents, open a supply store, have my products produced, right, trademarked and everything else, protect yourself with the S-corp and become an employee of the business. So no business is, or no structure is a one size fit all. Just because this hairdresser is S-corp don't mean you have to be S-corp. Don't mean you have to be LLC. It's what do you want to have for your business? What is your ultimate goal from a business standpoint? Because one thing that people also get confused about is sole prop. Sole prop is not even looked at as a business in certain industries. Right, you can't.
And it's the highest. It's the highest risk.
It's the highest risk. It's the highest tax structure or bracket, right? Because people look at, oh, well, if I take a loss, okay, but you're still responsible. You're not contributing to your retirement. So if this is your primary anything, how you plan to retire later on? If you constantly taking a loss, because some people think they're supposed to start a business so that they can reduce their taxes. No, you go into business to make a profit, not to have people get that confused. Like, I hear that from people.
I'm sure you do. I am
so
sure.
I can reduce my taxes. No, that ain't what you starting a business for.
Absolutely. I think it is very, very important for people to understand the tax laws and what they should and shouldn't do when operating a business. I know a lot of people haven't gotten licenses because they say, well, I don't want to be paying taxes. But the thing about that is this: you only pay taxes when you make money.
Right.
And so the fact that my friend, one of my friends, and I won't call her name, and she said, people talk about that. She said, but I used to look at taxes like a bad thing. But then she's a multi-million-dollar person, business owner. And she's like, but now I look at it as I pay as less tax I can because I make sure I use all the different, the different credits and things. She said, but when I pay taxes, it means I've made money.
Right.
And so it's not a bad thing anymore.
That's you're doing something right in your business, right? Like I said, who going to business to not make money? That's not the goal of a business.
No, that's not.
You're going to leave a legacy with a negative. You're going to leave them in debt. What? I mean, you can't do nothing with a negative. You can't even get a loan with losses.
Exactly. And so that's the thing, is to help businesses become more knowledgeable about tax laws. And you guys, I hope you received, Tracy, please put your information back up so that anyone that needs to contact her, I hope you reach out to her, because nationwide, and that's the thing, is like taxes are federal. And so it accounts for all of our states, all 51 United States. Okay. So it's federal. It's not like it's local. It's not like you have to live where she lives. It's like if you're in the United States of America, the federal taxes cover us all. So it doesn't matter what state you're in. You can use this information because it is a federal situation and not a local one and not a state one. This is federal taxes we're talking about here. So you are welcome to come and contact Tracy and ask her questions, like, see if she can walk you through some things. It's tax season, guys. And I know I see all these new cars with these drive-out tags. That's why I was surprised to see that January 24th is the day that they're going to open up the IRS, because these people riding around with car tags, drive-out tags already. I don't know what they're doing. That's actually my granddaughter's birthday.
Oh, okay.
The 24th, my third granddaughter. But yeah, so you all need to contact her. There's her information for you to go back and get in touch with her. Send her your questions. Like, each one of us, our tax situation is individualized.
Yes, very much.
And that's why there's no one set of rules for everybody, because we have different assets, we have different attributes, we have different things that we're doing in life. And because of that, your taxes, your federal taxes, are individualized based on who you are, what you do, and how you do it. So that's why a conversation is warranted anytime you're talking about federal taxes.
Very much so. And
so if you have one takeaway for them, Tracy, what would it be?
Outsource. Be good at what you're good at and let somebody else be good at what they're good at. Because time is money, and it costs you more in time than it would cost you in money to just outsource.
I love that. I love that. I always say, hire for your weaknesses and work in your genius.
Yes, I love that.
If you can work in your genius all day, every day, you'll be a happy camper. But when you try to go outside of your genius and be everything to everybody, that's when it gets the ball of confusion. So my name is Linda Murray Bullitt. They call me the Business Plug. You just tuned into the Business Plugs Mixer. I am available on Sundays at 7 p.m. Eastern Time, and you'll get to see this and many of these types of broadcasts during 2022. I want to introduce you to the tools and the people you need to know in order for you to become and remain sustainable. So check me out next Sunday at 7 p.m. at Eastern Time, and you'll see a whole nother thing. So Tracy, thank you for joining us. We really appreciate you. Good night, everybody. Let's hope you have a great rest of your weekend.